Thanks for joining us today as we discuss the FASB's new hedge accounting standard. I'm Shandy Smith, Senior Investor Liaison at the FASB, and with me today are FASB Board Member Mark Siegel and Assistant Technical Director Shane Kohanek. So guys, there's a lot of buzz around this new hedge accounting standard, which was issued in late August. Let's start with some basic questions. Mark, why did the board feel the need to address hedge accounting?
Well, Shandy, for years investors expressed concerns over the way hedging activities are reported in the financial statements. They noted that the effect of hedge accounting on reported results is often difficult to understand and interpret. Additionally, preparers expressed concerns over the difficulties associated with applying hedge accounting and the limitations for hedging both non-financial and financial risks in the current accounting guidance. So anytime you have difficulties in applying the accounting and difficulties understanding the financial results of the accounting, we see an opportunity for improvement.
That makes sense, Mark. So can you just take a step back and explain the need for hedge accounting in financial reporting?
Sure, I'll give it a try. Hedge accounting is needed because while accounting rules require derivatives to be carried at fair value, with their change in values being recognized in income each period, the risk those derivatives are hedging, for example, changes in inventory prices for inventory that hasn't yet been purchased, those are not marked to fair value each period. So the accounting mismatch that results creates all kinds of volatility that investors and companies believe don't reflect the economics because the change in value of the derivative is meant to offset the change in value of the underlying exposure. Hedge accounting, at least when a company's transactions qualify for it, essentially considers both of the transactions together for financial reporting purposes. So it allows companies to better reflect the effects of the risk mitigation strategies they are employing.
So Shane, can you give us a basic example of the accounting mismatch that Mark referred to?
Sure. So here's a simple but typical example. Let's say a company needs corn a year from now to meet its manufacturing needs, and it wants to protect against future price spikes. One way to do this is to enter into a long-term purchasing contract directly with the supplier, but those aren't always available. So instead, they buy a futures contract on corn at $4 a bushel a year from now. Without qualifying hedge accounting, the derivative gets marked through the P&L, creating volatility even though the corn hasn't been purchased and sold. Yet all the company wanted to do was lock in their purchase price at $4 a bushel. With qualifying hedge accounting, any gains or losses from the futures contract going up and down each period are reported in equity, in other comprehensive income, or OCI, and do not affect net income until the inventory is purchased and sold, at which time the two pieces, in this example, the futures gain or loss and the purchase of corn, are reflected together such that the cost of inventory is reflected as $4 a bushel. As a result, the income statement reflects the company's risk management activity, which was designed to lock in the price of its ingredient at $4 a bushel.
Okay, so what about an example that involves hedging financial items?
Sure. So let's say I want to hedge my exposure to changes in interest rates for fixed rate debt. I could enter into a swap to convert the fixed cash flows of the debt I have to a variable rate cash flow. Without hedge accounting, the swap is marked to fair value through the P&L without any offsetting change in the value for the underlying debt. Hedge accounting eliminates this mismatch by providing for a basis adjustment to the underlying debt. In other words, the change in value of the swap would be offset by the change in value of the underlying debt each period.
So is it fair to say that allowing more transactions to qualify for hedge accounting should result in less financial reporting volatility because the offsets you mentioned would be reported together?
Assuming they elect to apply hedge accounting, I think that's a fair statement.
So hedge accounting isn't new, Mark. It's been around for a long time. So what exactly has changed with the new standard, and why are companies so excited about it?
Sure, Shandy. Yeah, it has been around for a long time now. Hedge accounting has allowed companies to account for derivatives in ways that minimize or eliminate the accounting mismatch and reported volatility. The new rules simply will allow more hedging and risk management strategies to qualify for hedge accounting. So for example, it will allow component hedging of non-financial risks.
Okay, Mark, so exactly what does that mean? Can you explain component hedging of non-financial risks?
Well, sure. First, I guess the term non-financial is pretty obvious, but it refers to something that is not a financial instrument, something like the hedging of corn. That contrasts with the interest rate hedge example, which is hedging risks that are financial in nature. So let me step back. Today, in order to qualify for hedge accounting, the movement of the derivative must be highly correlated to the movement of the underlying risk. In other words, it must really hedge or offset the risk. Companies have been able to carve out a single component of financial risk. So, for example, the benchmark interest rate is a component of the total interest rate charged for a borrower. And so they could carve out that single component in order to use derivative contracts to hedge a specific financial risk, like the benchmark interest rate in a financial instrument. But the same hasn't been true for non-financial items. So in the example we gave earlier with the corn, if the ultimate purchase price of our corn per bushel includes cost to transport and store the corn, then a derivative for just the raw corn ingredient may not qualify for hedge accounting today because it may not meet our stringent correlation requirements. In the new rules, the board said as long as the risk is specified within a contract, it could be carved out and hedged. So what that means is that as long as the component price of the corn could be specified separate from the other costs, the hedged relationship can qualify. And this really wasn't possible under the previous rules.
Okay, so it sounds like more commodities being used in production should qualify for hedge accounting. Does the new guidance also expand the hedge accounting for financial risk, Shane?
Yes, the new guidance also expands hedge accounting for financial risk components. Specifically, the amendments permit more flexibility in hedging interest rate risk for both variable rate and fixed rate financial instruments.
So there were already several rates allowed, but we basically added the SIFMA rate as an appropriate benchmark when hedging a fixed rate and any contractually specified rate when hedging a variable rate.
So it sounds like there's clearly an expansion of risks that can be hedged. So this sounds like it would impact a lot of industries. Is that right?
Yes. Any company that is hedging their debt, so literally any industry, could be impacted. But for obvious reasons, the banks, insurance companies, and those who make extensive use of commodities in their production processes, those are probably the most likely beneficiaries.
So were these companies not hedging those risks before as a result of the difficulties of applying hedge accounting?
No, that's probably a good distinction to make. In most cases, I think they are already hedging their risks using derivatives, but since hedge accounting was difficult to qualify for and apply, they were simply reporting the quarterly hedging derivative gains and losses as non-GAAP and asking investors to ignore them. So now they have less reason to do that. So back to our corn example, they would say, well, we had a loss this period of X, but you should ignore it because effectively we fixed our corn price at $4 a bushel, which you will see once the corn shows up in our cost of goods sold next period. That being said, I believe that there could be some new hedging strategies unearthed as companies focus on new ways to hedge their risks using derivatives that now qualify for hedge accounting.
Okay, that's interesting. So you mentioned that the new guidance will also improve understandability of the results. Can you talk more about that, Mark?
Sure. The new guidance enhances the transparency, comparability, and hopefully the understandability of hedge results through enhanced disclosures and changing the presentation of hedge results to align the effects of the hedging instrument and the hedged item. So for example, the new rules say that changes in the value of the derivative should be included in the same income statement line item as the earnings effect of the hedged item, which say inventory. Previously, there really wasn't any guidance about this, so each side of the hedging relationship could be reported in two different places in the P&L. For example, the hedged item in cost of goods sold and the derivative fair value changes could show up down below in other income or loss. Even though they offset each other for net income purposes, the presentation was confusing. Now those amounts will be recorded in the same line item. Note that this could have implications for cost of goods sold and thus gross margins or other line items where the items being hedged are recorded today. Now, we also amended the current tabular disclosure of hedging activities in the footnotes to focus on the effect of hedge accounting on individual income statement line items for the period. So investors should be able to answer the question, how did companies' hedging activities affect its financial performance?
That seems like it would be really helpful. So are there any other disclosures that are being added as the result of the standard?
Well, we also required a new disclosure that will provide investors with more information about cumulative basis adjustments and fair value hedges.
So what could an investor do with that information?
Okay, so if you have, say, a fixed rate debt on the balance sheet that you've converted to variable rate debt through the use of a swap, the cumulative basis adjustment will show you both the remaining contractual amortized cost of the fixed rate debt as well as the amount by which the debt payments have effectively been altered by the swap. So taken together, these reflect the net debt amount presented on the balance sheet. So, thinking about the example Shane mentioned before, where the change in the value of the swap would be offset by the change in the value of the underlying debt each period, this disclosure provides more transparency about the impact of those two changes.
That sounds like a lot of good new information. Is there anything else investors should be aware of in terms of the presentation of hedging results? Shane?
Yes, I'd like to point out that the new guidance also decreases the complexity of understanding hedge results through eliminating the separate measurement and reporting of hedge ineffectiveness, or the amounts by which the hedge did not perfectly offset the underlying hedged item. Specifically, we know that mismatches between changes in the value of the hedged item, so the corn in our simple example, and the hedging instrument, the corn future, are still likely to occur. But these mismatches, or ineffectiveness, will no longer be separately reported. Previously, these amounts were reported separately and inconsistently from company to company throughout the income statement. Now they will be reported at the same time, where the effective portion of the hedging instrument is also reported, which is also where the hedged item is reported. So, as Mark mentioned before, this has implications for cost of goods sold and gross margins or net interest margins, and for that matter, any line item where the items being hedged are currently reported.
Well, that definitely sounds like an area where investors will want to spend some time understanding the implications for the companies that they're following. And I know from experience that based on our outreach with investors, many don't seem to understand under today's reporting what ineffectiveness is, what it represents, or where the ineffectiveness is being reported. So it sounds like from what you're saying, for cash flow and net investment hedges, for effective hedges, all changes in the value of the hedging instrument included in the assessment of effectiveness will be deferred in other comprehensive income and recognized in earnings at the same time the hedged item affects earnings and in the same place, rather on the same income statement line item. Is that correct?
Yes, that's right.
Okay. All right. So are there any other notable changes resulting from the new guidance, Mark?
So for the hedging of financial risks, the board's decisions make it easier to hedge portions of portfolios of financial assets. For example, the portion of prepayable assets they don't think will be prepaid. Previously, this was really difficult or probably nearly impossible.
Shane, can you explain that concept further, the hedging of prepayable assets?
Sure. The new guidance expands hedges of interest rate risk for closed portfolios of prepayable financial assets or beneficial interests secured by a portfolio of prepayable financial instruments. Under the new guidance, a company can designate an amount that is not expected to be affected by prepayments, defaults, and other events affecting the timing and amount of cash flows. We refer to this as the last of layer method. Under this designation, prepayment risk is not incorporated into the measurement of the hedged item. Practically speaking, this means that portions of portfolios with prepayment risk, such as mortgages and other consumer loan portfolios and mortgage-backed securities, can now be hedged because a company can designate an amount of the portfolio not expected to be affected by prepayments, such that it is now easier for these portfolios to qualify for hedge accounting. Think of this as creating a debt instrument out of the total portfolio, meaning that for the portion of the portfolio designated, companies can assume all the assets in that portion have the same term, same benchmark interest rate exposure, and are not impacted by prepayments, which makes it easier to hedge the overall exposure of the portfolio.
Okay, so it sounds like we're talking about very large interest rate sensitive portfolios that it was previously difficult to hedge. Is that right?
That's correct.
Okay. And it's the last of layer approach. We're not going to call it the LOL approach.
No, we're not.
Okay. All right. So no wonder the banks are happy. It sounds like a lot of them will, try to take advantage of this new part of the guidance. So Mark, when is the new standard effective?
Well, for public companies, the guidance is effective for fiscal years beginning after December 15th, 2018. So basically that's 2019 for calendar year filers. And interim periods are quarterly periods within those fiscal years. However, early adoption is permitted, so I'd expect to see some companies begin reporting under the new guidance in Q4 of 2017, but probably more likely in Q1 of 2018. Now, for all other companies that aren't public, the guidance is effective for fiscal years beginning after December 15th, 2019, and interim periods beginning after December 15th, 2020.
Great, so right around the corner. So it sounds like to me that some companies have a real incentive to adopt early and investors have an incentive to get educated on the new standard. So I want to thank Mark and Shane today for joining me on this podcast. And if you're listening and would like more information on the Hedging project, as well as other FASB projects, visit www.fasb.org and check out the Investors section under Quick Links and select Educational Resources for Investors. Or from the main page, select Projects and then Recently Completed Projects, or you can call me, Shandy Smith, at 203-956-5311.